Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. And you know what? It's just such an honor to have a series of experts that take this serious. Taylor is actually out on a family vacation, but he said, no, I'm committed to this hour on Monday, so I'm going to give it to you. So Taylor, thank you so much.
Yeah, I appreciate coming on every week. This is fun. Let's do it.
So where is Taylor and family? Where's the vacation spot for y'all?
Yep, we're in Dewey Beach, Delaware. So it's funny. I have myself, my wife, and my little girls, and then my sister and her husband and their little girls, and then my brother and his wife and their little girls, and then so all girls there, and then cousins that have boys and girls. So it's just like
it's a madhouse.
It's awesome.
It's awesome. That sounds like a total blast. Well, hey, the first thing I want to ask you is I need you to explain something to me. I've been looking at this market pretty in detail for 30 plus years. And why the hell is the 10-year note crashing again today? It's down like, 7 points or something. So what the hell? The Fed is fighting inflation and they've raised it 150 basis. They're going to raise again in September. Explain to me in simple English why the hell the 10-year note is crashing. And oh, by the way, mortgage rates are going down. What the hell?
And the diverting path between stocks and bonds right now is also
right? Exactly. What the hell? This is all just wacky to me.
Yeah, so it's funny. The market is very clearly through the bond market articulating that we're going to go into recession. So right now, this is the most inverted the yield curve has been, the most upside down the yield curve has been.
Yeah, 43 basis points. I just saw this morning.
Yep, I think it peaked in 2000 at 50 basis points. So again, we've talked a lot about this, but just to reiterate what we're talking about here is right now, the 2-year treasury is paying 44 basis points more in yield than the 10-year. We always use this example of like, Michael, if I'm lending you money or you're lending me money, more likely than me. If you're lending me money, are you going to charge me a higher rate at 10 years or at 2 years?
Yes.
Like any idiot out there is going to tell you at 10 years because it's going to take a lot longer to get the money back. But that's not what's playing out right now. And what the market is effectively saying in that is, although it sounds counterintuitive right now, is that the Fed is going to have to cut rates.
That's what the bond market, actually both. Yeah. I think that's what both are saying.
So that very well could be. Right now, today, the big movement in bonds is due to the fact that there was a survey put out that says most folks effectively think that inflation is coming down more meaningfully. And so they said that you're seeing gas prices roll over. And now, which is obvious because the pump is down about $1 per gallon, but they're also saying now that food prices will start to come down, which we obviously haven't seen that. And you and I have talked at length about that.
It's coming, yeah.
So, but again, go ahead.
I'm just looking for the article. Basically, there was just a Fed survey. Oh, here it is. Consumer inflation expectation took a major dive in July. So this is news. It didn't actually make my daily financial news because it came out an hour ago. But yeah, that's important, right? Consumer expectations is something that the Fed is looking at. And again, we were all taking pictures of our gas pump 6 weeks ago.
Right.
Now we're not. So
right. Yeah. And to put some context around the outside of that is consumers expect over the next year inflation to be 6.2% and then run at 3.2%. So all the way from 6.2 to 3.2 over the next 3 years. So that's obviously a meaningful drop off. And the market is actually, we've talked at length about this, Michael, like the market's been saying that for a long time, but the consumer certainly has not felt that. This is a consumer report by the New York Fed.
Yeah.
So again, the market is now coming around to the fact that I believe the only way for those numbers to come to fruition is a recession. And you just look at the logic of the numbers. We're at 9 right now, and they're expecting an average of 3% over the next 3 years. Obviously, it has to fall off a cliff. Yeah. So here's just a couple stats. Like there's been 12 recessions since World War II. So there's been 12 of them. 11 of them have been preceded by oil shocks, which again, oil's coming down now, but we certainly saw an oil shock. The price ran up and it doubled, right? So 10 of them have been preceded by short-term rate increases, which we're obviously still seeing that right now. So there's a confluence of things going on right now that are screaming recession. The stock market isn't, because we've seen a nice rally in the last month and a half or so, but the yield curve's inverted. We've seen 2 consecutive quarters of GDP negative, which is kind of the rule of thumb. But we all know that the labor market's so strong right now that could not be officially deemed a recession by the NBER. But the other thing that I think is going underwhelmed right now by the market is the fact that we're going from quantitative easing The Fed saying,
Yeah.
come on, I'm going to buy every bit of bonds in the mortgage market, in the treasury
Yeah.
market. Not
Yeah.
every bit, but
Yeah.
that's
Enough.
hyperbole.
Yeah.
Enough, right? Let me continue to buy, I think it was $20 billion worth of mortgage-backed securities with houses having gone up 20% over the last year. This is logical, right?
Yeah. Yeah. Yeah.
Any idiot looks at them and says, what are you doing?
What are you
But
doing?
they're now going from we're buying everything to now we're letting our balance sheet roll off. And we're no longer going to be that omnipotent buyer propping up the
Yeah.
market from beneath. So that's something that's really interesting. And then the last thing I'll say, and I will shut up. I'm on fire on vacation.
This
I'm not
is
sure what's going
great.
on
This
here.
is awesome.
Is that we've had 4 consecutive negative months of leading economic indicators.
Yeah.
So, we talk about the fact the labor market's strong, and that number last week was wildly strong.
528. A double,
528, that
roughly
was
a double. Yeah.
Yeah, exactly right. So that was oh boy, where is this coming from? And we just have to remember that labor, and I've talked to you about this a lot, is a lagging indicator, right? So the leading economic indicators like manufacturing data, like building permits, like the stock market, like the inverted yield curve, those are all leading economic indicators. For 4 straight months, they have been negative.
Yeah.
So it's what's happening right now. Right now, we're in this kind of fanciful movement upwards of the market in the short term, but it's kind of, the storm clouds are still out there and the market's saying the storm is going to hit us.
Yeah. The other thing I wanted to ask you about, because you're the right guy of my expert series to ask this question of, because we've actually talked about it in some of your past videos, is I actually think this might be a sign that there's a worldwide recession. So not only a U.S. recession, but there's, Europe, big trouble. I think Asia, I think China's in worse shape than they're letting on. I think Australia, I think there's a worldwide recession going on. And if that's the case, you probably have a lot of foreign governments, they're basically replacing the Fed as the biggest buyer, hence driving rates down. I think that's being underappreciated. Am I maybe missing something, or maybe that might be?
No, and we did have this conversation once before, and afterwards I did go and look, and because I didn't know the answer, full disclosure, that there have been 4 global recessions in the past where systematically across the globe GDP has gone negative for 2 consecutive quarters. There have been 4 historically. So no, you're not wrong at all. And so what you see is that everyone's rates on their bonds right now are coming down, and we're like the smartest dumb person, if you will, where our 10 years at a 100 or 200 basis points higher than they are in Japan, in Germany, in a lot of the other developed nations around the world. So when we get a little bit of a movement upward in rates, which we've seen now and again, what you have is this foreign influx of money coming in and saying, hey, we'll take yours at 2 to 3%, wherever it is at that given point, over mine at 0.5%. And effectively, you also have to realize that what you're betting on when you're saying, hey, I would rather own a German versus a US bond, is the overall sovereign ability of that country to pay down its debt. And realistically, and our country's not perfect, don't get me wrong, but who, from a fiscal standpoint, has the best ability to pay down debt? I think it's arguably the United States. And when things get out of whack, which they are right now, you get that foreign influx of buying. And it's not only foreign governments that are buying, like the Chinese government obviously buys a lot of treasuries, but it's also, think about pension insurance companies from overseas stepping in and saying, hey, we have to it's called liability driven investing. Essentially, we know what our future liabilities are from a payment structure standpoint. If we can offset that by a bond that gives 3% that matches up with one of our future liabilities, boom, done. That's called immunizing duration. And that's called systematically paying. And that you're locking in that payment.
Yeah, and I think
that's in the weeds. Sorry.
No, that was, dude. I guarantee everybody's going to love that. Probably most people will rewind and watch that again because it was awesome. But also, I think there's a lot of foreign governments and institutions looking at currency risk, right? The dollar is super strong.
Holy smokes, yeah,
holy smokes, right? So again, they're looking at our rates and they're going, hey, they're getting out of their own currencies. This QT thing, it's still, to me, it's the most frightening thing to think about.
It is, because it's the most unknown, really. That's the big problem, is that
it's going to break something. It's going to break
something. And you have to also realize that, it's not just us in the United States that are going through this tightening process. It's around the world right now. Essentially, developed nations So like, we bang on the Fed and they deserve it. Don't get me wrong.
Yeah,
But at the same time, like the Fed didn't drive inflation in Europe.
No,
right? So
no.
like there are macro forces with the supply chain, with the oil shock, with some of those other things that, COVID and the fact that we flooded money, like, well, I guess that is kind of some Fed that's fiscal.
Yeah.
But anyway, what I'm getting at here is like the Fed didn't drive worldwide inflation.
No.
We would have inflation even if the Fed didn't misstep right now. And they did misstep. I'm not saying they didn't.
Yeah. This is it's just a wild ride. And I think what's happening now to me is the Fed stepped away. Rightly, they stepped away late, but they've stepped away. But I think what happened is I think the amount of foreign buyers I think that's what's happening, because that's the only thing that I could explain such a large and precipitous drop in the 10-year, right? It peaked at 3.49. It's now at 2.66 or whatever the heck it's at. And it seems to want to go lower. And dude, here's the deal. We're actually going to have a brand new topic number 2. We're going to talk about Wednesday's CPI next. But let's just say this. If CPI comes in at like 8.5 or 8.3, the 10-year is going lower, right? It's just going to be crazy. So let's save that for episode 2.
I'll just say one more thing on this. Yeah, I'll say one more thing on this. You also have to realize that the 10-year and further out, the 20-year, the 30-year treasury is also an insurance policy too.
Correct.
So like when people are offsetting risk in their portfolio, they want to take long duration because that is the ultimate offset to risk.
Totally
so for what that's worth, also hedge funds, et cetera, when they're like, we're not sure.
I don't know.
Yeah, exactly. They hedge their bet on the other side. So yeah, but no, thanks for asking. They can find us at Life Goal Investments on Instagram is the best place to find us.
Yeah, you got to watch them. Life Goal Investments. I watch them every day. They put out amazing stuff to make you think and you learn. It's educational and it's fun. You do a great job, Taylor. Thank you.
You're the man, Michael.